Hi everyone, welcome to another episode of the Patient Wallet channel. Today I am going to be explaining why I think Amazon is the best stock to buy today, as in my opinion it has all the right elements to benefit from a number of tailwinds and is one of the best physical infrastructure plays in the market today. The market is sleepwalking when it comes to Amazon, and I believe investors are running out of time to buy Amazons at these levels, so let's get into the video. For full transparency, Amazon is my top holding today, so please make sure you do your own research before you take any financial decisions. Do me a favor, like the video, subscribe to the channel, and let's kick things off with Amazon's MOAT. The Amazon flywheel is about to get much more tuned in, leading to acceleration of most of its businesses, increased margins, and higher cash flows generated from the business. I personally think of Amazon as an infrastructure play with add-ons on top. Amazon is the largest fulfillment center company in terms of global warehousing space. It is the largest cloud provider, likely the largest company employing robots for its own operations, and now with Project Kyber, one of the most integrated infrastructure plays that I can see today, touching current and emerging industries and technologies. Of course, everything started with the Trojan horse, which is Amazon Marketplace, but the company is much more than a marketplace today. Ultimately, when it comes to financial data, this mode and its durability translates to cash flows from operations. Over the last 10 years, cash flows from operations increased by 985% at a CAGR of 27.7%, and for the last 12 months, CFO sits at $131 billion. So I'm going to talk about these three areas that I think the market is currently underestimating, but ultimately will lead to a faster flywheel and help Amazon continue to compound its cash flows at high rates going forward. Starting with AWS, last quarter we have seen AWS revenue reaccelerate, achieving a 20% growth rate and $33 billion in revenue for the quarter. When it comes to AWS, I track one KPI, and that is the remaining performance obligations. Are customers signing contracts committing to spend X amount of money with AWS? As of last quarter, the AWS performance obligations stood at a whopping $200 billion and continue to grow at a healthy pace. AWS's operating income follows a similar path, growing rapidly at a CAGR of 28% for the last 5 years, and the last 12 months operating income from AWS was $44 billion. I think this kind of growth continues well into the future. As we know, they continue to be supply constrained, i.e., demand is higher than supply. Management commented that they are planning to double their cloud capacity in the next 2 years, and Amazon is playing well the custom AI chip card. Signing deals with Anthropic to use their Trainium chips, they are able to showcase their capabilities to meet demand for AI that becomes cost conscious. Today, this might not be the focus for investors or customers given everybody's supply constraints, but once money becomes tighter, game on for Amazon, as costs will matter. We have seen what happened with Google's TPUs recently, and Amazon will follow very closely. Management also provided additional information on these chips on the last call. Trainium chips are engineered to deliver superior price performance for both AI training and inference, offering a significant advantage over other market alternatives. The current generation, which is Trainium 2, has demonstrated substantial success, being 30 to 40% more price performant than competition out there. This has led to Trainium 2 becoming a multi-billion-dollar business, experiencing 150% quarter-over-quarter growth and currently being fully subscribed. A notable deployment of Trainium 2 is Project Rainer, a large-scale AI compute cluster featuring nearly 500,000 Trainium 2 chips projected to expand to over 1 million by year-end. This cluster is being utilized by Anthropic for training its Claude AI model. While Trainium 2 primarily serves a limited number of very large customers, the upcoming Trainium 3 is expected to broaden accessibility, with a preview anticipated by the end of the current year and fuller volumes in early 2026. Trainium 3 is projected to offer an additional 40% improvement in price performance compared to Trainium 2, further enhancing its competitive edge. So when price starts to matter, AWS will benefit, and I wouldn't be surprised if we see $100 billion in operating income from AWS over the coming years. Next up, robotics and automation. I genuinely think nobody understands what's about to happen with Amazon when it comes to robotics and automation. Not me, not the market, and we are all going to be shocked as robotics and automation will touch every single business segment of the company and even create new ones over the next few years. Let me start with the obvious one. Online stores made $262 billion in the last 12 months. Keep in mind that you have mature and non-mature geographies in this mix. If robotics and automation can lead to margin improvement for online stores, you have massive amounts of cash falling to their bottom line simply because of their scale. A 1% margin improvement leads to 2.6 billion additional income, a 2% 5.2, 5% 13.1 billion, 10% 26.2 billion, and 50% margin improvement 39.3 billion US dollars. Not sure where we land, but two things happen. If management decides to switch on profitability mode, robotics and automation will add a significant amount of cash into the business. If they decide not to turn on the profitability switch, the flywheel gets out of control and nobody will be able to compete with them. If Amazon is able to reduce costs because of robotics and automation, they can then go ahead and reduce prices, which means more people will come to Amazon Marketplace. Amazon will be able to enter new markets more aggressively because of lower costs of operation, which ultimately leads to more people, more subscriptions, more third-party sellers, more advertisers, and on and on. And it's not some sort of a future play, it's already happening and we have been told. Amazon employs more than 1.5 million people, so it has plenty of room to improve margins, deployed its 1 millionth robot. Articles have been leaked suggesting Amazon is planning to grow without hiring an incremental 600,000 employees, and Andy Jassy himself told us in a memo, and I quote, "We expect that this will reduce our total corporate workforce as we get efficient gains from using AI extensively across the company." And as I said, online stores is the obvious play. Another play is some sort of offering know-how around robotics and automation. Think about how AWS started as an Amazon need and is now offered externally. Is there any other player that deploys today 1 million robots, moves so much material throughout its operations, and has the know-how to make the robots more efficient on how they operate or specialized for specific tasks? I don't think so because of the sheer scale of Amazon. So I wouldn't be surprised if we see Amazon offering this as a service, and that's where Project Kuiper comes in. This is something that is completely flying under the radar, but to me it is the cherry on top and crowns Amazon the ultimate infrastructure play that nobody will be able to compete with. So what's Project Kuiper? They rebranded this project as Amazon Leo recently, and is essentially Amazon's offering of fast, low latency and reliable internet, which will be provided by satellites. I'll talk about 3 cases on how this perfectly fits into the Amazon playbook. Project Kuiper will, in my opinion, re-accelerate AWS growth. The best example is a security play. Because of Project Kuiper, Amazon will be able to offer services that avoid the public internet and instead provide direct and encrypted links to AWS infrastructure, which is a security advantage. And again, we have been told about this. A recent article highlighted how Amazon will invest $50 billion to serve US government agencies. Second Project Kuiper application is around robotics and automation. Because of the high speed, low latency, and global reach, Amazon will be able to tune in their own warehouses, which should improve speeds or make operations more efficient. This is further adding to the flywheel of lower costs, more people, more subscription, advertising, etc., or makes it even more likely that Amazon can go ahead and offer automation or robotics as a service. They have the systems and know-how in place to help any business with their automation efforts. The best part though is that Project Kuiper will enable robotics offloading processing. And let me explain what this means. Because of the integration with Project Kuiper, robots will have this ability to offload complex processing away from the robot and onto AWS servers. The practical implications of this are that the robots will not require to have the heavy hardware on them to process or carry out complex tasks with their brains. Instead, they can be smaller, more lightweight, energy efficient, and ultimately cheaper to have and operate on the ground. This is the ultimate infrastructure play that puts Amazon years ahead of competition. And lastly, we have Project Kuiper capturing additional customers for their ecosystem, helping them grow in all directions. Let's say you live in a remote location with bad internet connection. If Amazon offers you the ability to have strong internet connection with Prime, are you not more likely to become a Prime member? I think you are. And once you are in the Amazon ecosystem, they will make sure they extract as much value from you as possible. You'll buy more from Amazon, which means they have more people on their ecosystems, which attracts more advertising and more third-party sellers. This is another addition that makes the flywheel spin faster and faster over time. And again, we have been told about this as Amazon has been expanding in rural areas recently. Okay, that's the MOAT. That's how I think of Amazon. So let's look at some additional data which I think make Amazon a buy today. Year to date, the company has been relatively flat, fluctuating just above zero. The last 5-year return was 44.6%, whilst operating cash flows per share increased by 122% or grew at a CAGR of 17%. As a result, the price to operating cash flow multiple decreased by 33% over this period and is now sitting at 19 times. And in my opinion, the reason for this is the CapEx cycle that the company is going through today. I personally see this as a positive for patient investors, but at the same time, markets are impatient and as a result are punishing the stock. When we compare the 5-year performance versus the big cloud players, Amazon underperformed by wide margin for both Google and Microsoft. Google's return was 341%, Microsoft 132%, and Amazon much lower at around 45 to 47%. At the same time, Amazon has invested significantly more than Google and Microsoft over the same period, and I genuinely believe this is something that neither Google or Microsoft are able or willing to do, and this is why I think Amazon outperforms both of these companies going forward. These investments will eventually pay off and shareholders are going to benefit. And last point on valuation, Amazon has the lowest multiple when it comes to price over operating cash flows, with Amazon sitting at 19 times, Microsoft at 25 times, and Google at 26 times. The market will wake up and realize that the Amazon flywheel and MOAT are becoming stronger over time, leading to high margin businesses continuing to grow faster than the low margin businesses, pushing overall margins higher and achieving a cash flow scale that is unmatched, making it impossible for anyone to compete with Amazon. Amazon is the best buy in the market today, in my opinion. It is the ultimate infrastructure play, and I am planning to add some more in my position soon. That's it for this episode. Let me know what you think in the comments below, and I'll see you in the next one.